$1 trillion, gone overnight. 4 years, Chinese capital poured into nearly every major sector of the American economy. From blockbuster movie studios in Hollywood to elite real estate in New York and billion-dollar funds on Wall Street, the U.S. was a prime destination for China's outbound investment. But now, in a calculated and silent move, Beijing has cut off the tap completely. No phased wind down. No vague warnings. Just a full and immediate halt. This wasn't a panicked overreaction. It was a precise, strategic decision, a financial maneuver in a conflict that's evolved far beyond trade tariffs and semiconductor bans. It's capital warfare, and the U.S. has just taken a direct hit that could reshape the future of global finance. In early March 2025, China's Ministry of Commerce issued a low-profile but powerful revision to its outbound investment guidelines. All non-critical capital flows into unreliable jurisdictions were officially labeled suspended. The U.S. was explicitly named. Then, on March 17, China's State Administration of Foreign Exchange, SAFE, followed with a confidential directive ordering a full freeze on new investments into American firms, citing increased geopolitical risks and asset security concerns. The directive wasn't announced publicly. It surfaced quietly in filings and was later confirmed by Reuters. The effects are already reverberating. Chinese investment in the U.S. had already plummeted since 2016, falling from $46 billion annually to just $2.3 billion by the end of 2024, according to the Rhodium Group. Now, that number is effectively zero. Peking University's Professor Zhao Daojiang described the move as a targeted decoupling, a way to drain U.S. financial strength without triggering retaliatory escalation. But here's what makes it even more significant. China isn't just pulling out. It's reallocating that capital. It's building something new. Throughout 2024, China trimmed $14 billion worth of U.S. Treasury holdings, its biggest annual sell-off since the 2013 taper tantrum. Current reserves sit around $775 billion and falling. Meanwhile, state-owned Chinese banks have begun severing dollar-based ties with key U.S. banking institutions. These shifts aren't symbolic. They represent a deliberate effort to reduce dollar exposure and move trade toward yuan-based or multi-currency systems. Commerce Secretary Gina Raimondo acknowledged as much in January, warning that Beijing is re-engineering its capital flows in a way that leaves the U.S. with less financial leverage and fewer options. The problem for Washington? Tariffs and tech bans move slowly, but capital exits can happen in a flash. And that's exactly what's happening. Even more concerning, China's departure appears to be contagious. Norway's sovereign wealth fund pulled $7.1 billion from U.S. tech in early 2025, citing excessive policy risk and fears of regulatory retaliation. Japan's Government Pension Investment Fund, GPIF, the world's largest, cut U.S. commercial real estate exposure by 30% after a series of Moody's downgrades on regional banks. These aren't just isolated divestments. They're tremors signaling something larger. According to UNCTAD, foreign direct investment into the U.S. fell by 22% in 2024, with early 2025 projections showing another 19% drop. And the cracks are showing across corporate America. Over $4.1 trillion in U.S. corporate debt comes due by the end of 2026. But with foreign investors vanishing and local lenders tightening terms, companies are being forced into expensive borrowing. In 2024 alone, more than $430 billion in junk-rated bonds were issued, up 38% year-over-year. Yields hit a painful average of 9.6%, almost double from 2022. Take Hartwell Tech, a mid-sized manufacturing firm based in Boston. Their $180 million equity deal with a Chinese venture firm vanished in March after SAFE's directive. Scrambling for alternatives, they turned to Apollo Global for emergency bridge financing at a steep 11.3% interest, secured against patents, machinery, and real estate. It's a textbook case of survival mode financing. According to Fitch Ratings, 1 in 5 U.S. mid-sized companies now faces significant refinancing risk in the next 18 months. The once lucrative world of equity capital has dried up. What's left is expensive debt and tough terms from private credit lenders demanding collateral-heavy, short-term deals. But wasn't America supposed to be shielded from this? In 2025, President Trump expanded tax breaks to incentivize reshoring, an effort to bring manufacturing back to U.S. soil. Yet the National Association of Manufacturers reports that 62% of firms planning domestic expansion now face critical funding gaps. The common reason? A lack of international capital partners, most notably Chinese investors who once bridged funding gaps for industrial startups, energy projects, and AI development. Even more concerning is the loss of non-monetary value that came with Chinese capital. These investors didn't just bring cash, they offered strategic supply chain access, deep technology know-how, and bridges to Asian markets. With that synergy now cut off, American companies find themselves isolated. Meanwhile, China is reinvesting elsewhere. It's deepening ties with Saudi Arabia, the UAE, Brazil, and Indonesia. Belt and road projects have been quietly rebranded under a global infrastructure partnership, creating investment safe havens far from Washington's reach. Beijing isn't pulling back from the world. It's pulling back from America. And the US? It's facing a massive funding vacuum. Domestic banks are cautious, venture capital is drying up, and institutional investors are increasingly wary of market instability tied to political volatility. The cost of capital is rising. Innovation is slowing. And the clock is ticking. This isn't just capital outflow. It's the start of a potential financial decoupling that could leave lasting damage. The question now isn't whether China will reverse course. It's whether the US is prepared to fill the void, or if it's walking into a debt trap of its own making. Massive projects announced just 2 years ago, once hailed as proof of US manufacturing revival, are now stalling or collapsing under financial pressure. In Michigan, the $8 billion battery plant backed by Chinese capital is on indefinite hold. Nevada's $3.1 billion robotics campus? Quietly canceled. Even high-profile initiatives like Intel's $20 billion semiconductor facility in Ohio, long considered a flagship of American chip independence, just paused its second construction phase due to rising costs and uncertain funding timelines. As economist Ishwar Prasad noted in Bloomberg, without access to diversified capital, these projects risk becoming symbols rather than solutions. The U.S. reshoring push, intended to rebuild supply chains and reduce foreign dependency, is increasingly colliding with a hard truth. The math of capital scarcity doesn't care about politics. And the pain isn't just on the industrial side. It's creeping into household budgets. President Trump's expanded 2025 tariff regime now affects over $500 billion in Chinese imports, up from $370 billion under his previous administration. According to the Peterson Institute, the average tariff rate has surged to 22%. The result? Skyrocketing prices for everyday items. Appliance prices alone jumped 16.7% year-over-year in Q1 2025, based on data from the Bureau of Labor Statistics. Consumer electronics, auto parts, and home goods all followed. Walmart and Target have each posted margin warnings for 2 consecutive quarters, blaming direct tariff exposure. And the National Retail Federation estimates that the average U.S. household will pay an additional $1,950 in 2025 just due to increased import costs. The corporate world is feeling the pressure too. In Q4 2024, S&P 500 earnings rose by just 1.2%, down sharply from 4.5% the previous quarter. Companies are caught in a vice: absorb rising costs and hit margins, or pass them on and risk crushing already stretched consumers. With inflation still stuck above 3.6% and real wage growth nearly flat, it's a lose-lose scenario. But here's what's more alarming: this might just be the warm-up act. The Economic Policy Uncertainty Index, developed by Baker, Bloom, and Davis, reached its highest reading in over a decade in Q1 2025, exceeding even levels seen during the 2008 financial meltdown and the 2020 COVID lockdowns. What's fueling the spike? A perfect storm of aggressive rate hikes by the Federal Reserve, erratic fiscal decisions from Congress, and volatile, unpredictable trade policy. Business leaders are rattled. The Conference Board's CEO Confidence Index plunged to 37 in March 2025, the lowest since mid-pandemic. A staggering 68% of executives said policy confusion is making long-term investment planning impossible. Bank of America analysts warned back in February, capital formation isn't stalling due to interest rates. It's stalling because of chaos. And investors are voting with their feet. Over $120 billion has been pulled from U.S. equity ETFs in just the last 90 days, according to Bloomberg. Foreign investment is also slowing. UNCTAD reports that foreign direct investment into the U.S. dropped 22% in 2024, with 2025 projections showing another 19% decline. Globally, the shift is clear. After Chancellor Friedrich Merz visited Beijing in February, German chemical giant BASF announced a $10 billion expansion in China. France's economy minister Bruno Le Maire followed with a new LNG deal with China, denominated entirely in yuan, not dollars. The European Chamber of Commerce in China reported a 19% surge in Q1 European capital flowing into China's industrial hubs, citing one common factor: policy stability. Saudi Arabia, too, is hedging. Riyadh has been steadily divesting from U.S. treasuries and just allocated $27 billion into a joint AI investment fund with China and Singapore, marking a quiet but definitive shift in long-term financial alignment. Former IMF chief economist Kenneth Rogoff recently told the Financial Times, "The U.S. isn't losing allies, but it's losing its gravitational pull." It's not that America's friends are defecting. They're diversifying, a survival response to Washington's volatility. Meanwhile, China is playing the long game. The China Securities Regulatory Commission in March approved fast-track rules for foreign IPOs in Shanghai and Shenzhen. Already, 38 new listings have launched in Q1 alone, a 52% increase over the previous quarter, per Quinn Global. And more quietly, China's sovereign wealth fund increased its exposure to ASEAN sovereign bonds by $19.4 billion, based on a leaked HSBC report. Perhaps the most transformative development? The digital yuan, eCNY, is now partially integrated into SWIFT Lite, allowing settlement across 13 countries, without touching the US dollar. According to HSBC's Harold Wong, this isn't a dollar replacement, but the rise of enough options that the dollar's monopoly quietly dissolves. And if this continues, Wall Street may soon wake up to an even more chilling reality. The money didn't just leave, it chose not to come back. Now your turn. What do you think? Is China's quiet retreat a temporary tactic, or the start of a financial realignment that could upend US dominance? Should Washington respond with force, or with reform? Drop your thoughts in the comments below. Let's hear your take on this financial power shift. And if you found this deep dive valuable, don't forget to like, share, and subscribe for more analysis on the shifting dynamics of global finance.